Have you ever been told that taking on tens of thousands of dollars in student loans is a smart, necessary investment in your future? Society comfortably slots student loans into a safe middle ground. They tell you it's much better than racking up a high-interest credit card, even if it's not quite the same as taking out a mortgage on a home. But here's the brutal reality. A bank can repossess your house or car. They cannot repossess your degree. Because you can't sell it back, it acts as a permanent anchor. Whether you lose your job or hate your career, the debt stays attached. You are staring down a decision that determines whether you spend your 70s sipping cocktails on a beach or stretching a fixed income to pay for a tiny studio apartment. Taking an unsellable, permanent obligation and labeling it as good debt is the exact mechanism keeping millions of highly educated people completely broke. Look at this timeline charting a standard repayment plan. We'll call this Path A. A graduate makes a $400 monthly payment, stretching it across 15 years. Because the interest rate sits at a moderate 3 or 4%, that monthly minimum feels manageable. Borrowers often justify this slow approach by assuming they are getting a great tax write-off. But unlike a mortgage, the ability to deduct student loan interest phases out and completely disappears once your income crosses a certain threshold. The real wealth destroyer is opportunity cost. By tying up $400 every month, you miss out on decades of compound growth. This shadow curve shows what happens if that same money was invested in an S&P 500 index fund instead. When you blindly accept a monthly payment as a normal fact of life, you quietly drain hundreds of thousands of dollars in potential wealth from your own future. But the math is only half the problem. The weight of this debt creates a devastating psychological condition: change paralysis. When you have a mandatory, inescapable loan payment hanging over your head every single month, you become terrified of taking calculated risks. You might know your current job underpays you by 20%, but switching companies means giving up a comfortable routine, and you need that guaranteed paycheck to meet your minimums on the first of the month. You might have a great idea to start a business or the leverage to negotiate a higher salary, but the fear of missing a payment prevents you from taking the leap. The debt forces you to prioritize short-term stability over long-term growth. It feels responsible in the moment, but over a lifetime, it is financially reckless. Now let's map out the alternative on this graph. This is Path B. Here, the borrower attacks the loan using the debt avalanche method, aggressively paying off the highest interest rates first. The balance hits absolute zero in just a few short years. Getting there requires immediate sacrifice. Living far below your means, adding roommates to cut rent, and ruthlessly avoiding lifestyle upgrades. Then comes the pivot. The exact instant the debt is crushed, that freed up $400 is funneled into an S&P 500 index fund every single month. Without the drag of debt, those returns start generating their own returns. Compound interest violently accelerates upward over the remaining decades. Delaying your investing strategy to comfortably pay down a student loan results in a massive net worth deficit. Dragging out good debt literally means selling hundreds of thousands of dollars of your future retirement security just for the minor convenience of making minimum payments today. If you look at a perfectly optimized spreadsheet, the math might occasionally tell you it's smart to carry low-interest debt and invest the difference. But human beings don't operate on spreadsheets. The psychological freedom of keeping 100% of your paycheck is the actual engine of massive wealth creation. When you have zero debt and a fully funded emergency fund, meaning several months of living expenses saved in cash, you stop making life decisions from a place of fear, and you start making them from a position of absolute strength. Hitting that zero balance destroys change paralysis. It allows you to make the offensive, high-reward career moves you were previously too afraid to attempt. To escape this trap, you have to completely change your mindset today. Stop treating your student loan like a pet you plan to keep around and feed for the next 20 years. This flowchart outlines your escape plan. Step 1. Capture your employer 401k match. It's free money that outpaces any loan interest rate. After that, optimize housing costs, stop lifestyle upgrades, and violently throw every remaining bit of capital directly at the loan principal. Your financial destination is not determined by your family background or your starting income. It is entirely determined by the choices you make from this exact moment forward. Shatter the good debt illusion. Aggressively free up your monthly income, take back your financial control, and start paying yourself today.